Perfect. Okay, great. Good evening, everybody. You're very welcome to our investment seminar for 2025. So my name is Claire Hanrahan. I'm the Managing Director of Irish Pensions and Finance. I'm delighted to welcome James Forbes. He is the Head of Investment Solutions with Goodbody Asset Management. So I'll talk to James in a minute. And then we also are delighted to welcome Jack Stevens, one of our senior financial planners here at Irish Pensions and Finance. And also not to mention Sarah Connolly, our marketing manager and the person that makes all this possible. So thank you very much, Sarah. Okay, so before we get going, I just want to go through a few bits of housekeeping. We estimate the webinar is going to take less than an hour. All right. But following the webinar, Sarah, we are going to email on the slides to everybody who has registered.
We are indeed, yeah. We'll be recording, we'll send a recording, the slides, and we actually have an investment handbook we'll send on as well as a link that people, if they want to book in with an advisor, follow them on from this, or even just for an initial conversation, they'll be able to book that there as well, Claire.
Brilliant. We have a draw for €100 all for one voucher. So at the end of the webinar, we are going to ask a question. The answer to the question will have been revealed during the webinar, and the first person with the answer to that will win the €100 all for one. Okay. Speaking of which, we are going to keep the chat shut during the webinar because I suppose, look, we've had a lot of questions. So we're going to keep the chat closed, but James has kindly agreed that at the end, we will have some time for Q&A. All right. Now, look, we've over 550 RSVPs to the webinar this evening, and we've had an awful lot of questions. So we'll get to what we can throughout the presentation naturally. We'll try and answer what we can at the end. But if we don't get to your specific question, what we will do is an advisor will be in touch and they'll go through it with you individually. Is that okay, Sarah?
Oh, good. Yeah, sounds good.
Great. So look, a quick introduction to Irish Pensions and Finance. A lot of people, and actually we said we've over 550 RSVPs this evening. And what I'm absolutely delighted with is a lot of these are customers, existing customers that are on the call that have existing investments. So Irish Pensions and Finance, a lot of people know who we are. We're an Irish-owned brokerage. We're in business since 1993. Our flagship product is an AVC scheme, but we are, a full brokerage. And tonight we're going to talk to you about investments. You can check out our Trustpilot. We have 4.8 on Trustpilot, which is very, very highly reviewed. We've over 1 billion in funds under management. We've over 28,000 customers, and we've nearly 100 staff. Okay. As I said, I'm the managing director. James, you're very welcome. You're from Goodbody Asset Management.
Thanks very much, Claire. Delighted to be here this evening.
Great. And we were just saying, actually, this is the 5th year doing this.
Absolutely. I think we've had a great relationship, with your clients and with ourselves, and it's worked out very well. And maybe, Claire, before we kick off, I might just introduce myself. I'm Head of Investment Solutions at Goodbody Asset Management, and effectively what we do is that we manage a small number of funds, but those funds are available to IPF, and that's what we do. So if IPF are talking to you as a client, they'll suggest a number of funds. The Goodbody fund could be one of them. So it's just always important to remember that you're a client with IPF and not with Goodbody. We work with IPF on them.
Brilliant. Jack, you're very welcome this evening.
Thanks, Sarah. Yeah, delighted to be on here as well.
So how many, you're with Irish Pensions and Finance?
Just over 7 years now.
Very good.
So initially started on the admin side of things for about 2 years, and I've been a financial planner now for 5 years. Recently promoted to senior financial planner and recently passed the CFP. So I'm now a certified financial planner as well.
Excellent. Great. So I suppose when you are speaking to the people on the call tonight, you're going to be coming from, the advice point of view and what the customer should expect.
Yeah, exactly. Yeah. And as you mentioned, around the 5-minute phone call that everyone will receive over the next couple of days, it'll be myself or any of my colleagues that'll be speaking to the clients individually after this today as well. Yeah.
Brilliant. Okay, so will we get going? Sarah, do you want to move on the slides? Okay, so look, I think people who've joined this evening, if you come away with 3 things from tonight, I think that'll be absolutely excellent. We're going to talk about what the pros are of investing, but we'll also talk about the cons, okay? Because that's really important. There's going to be an awful lot of talk about inflation. So James, you're going to go through that quite, there's going to be quite a lot of information for people regarding inflation and how it affects their money. And then I suppose, what can people do to safeguard their money that's on deposit? Okay, so if people can come away with those 3 things from tonight, I think that would be a very successful webinar for the customers that are on the call. Okay, so we'll move on to the next slide. So Jack, I'm going to hand over to you here. So why typically would people decide to consider investing their money?
Yeah, it's a great question, Claire. I think that when it comes to investments, it's not very straightforward. I think there's 4 key areas that people need to consider when looking at investments. And the first one is around deposit rates. And the big thing really is that obviously the ECB have increased interest rates over the last couple of years. And although they've come down a little bit recently, you're not getting any returns in your savings in banks at the moment. So having that money on deposit there, it's not doing you any good, basically.
Okay.
In addition to that then as well, you also have the threat of inflation. And the example I always use for all of my clients is think about doing your local shop and say Lidl or Aldi. You bought €100 worth of goods this year compared to €100 worth of goods last year. The shopping basket this year is a lot smaller for the same price.
Okay.
So if you have €100,000 on deposit, imagine a thousand baskets of goods basically. And that's the idea behind it, is that keeping it on deposit, not earning any interest, will have a negative impact on your savings in the long term. And I suppose, like you said, James will go into this in more detail in a couple of minutes.
Okay.
In addition to that, then, we have the cost of living increases. So as inflation occurs, prices rise, and that basically means that your monthly outgoings increase. So if you think about your insurances, any monthly costs that you have, so your early bird meal might be a 3-course, used to be €25, now it's up to €40 or €50, and that's a big issue there. So we want to help you with your savings for the long term to gain you some interest. And
Very
then
good. Yeah.
I suppose,
I actually saw in the paper yesterday they were talking about health insurance has gone up across the board for everybody.
Yeah. My own health insurance this year, I renewed it last month, and it went up quite significantly as well. So, it is quite a common thing. And I suppose the last thing, Claire, actually around make your money work for you, is that everyone on the call here who has savings at the moment, like, think about how hard you've all worked to save up this money throughout your career over the last number of years. And the last thing you want to be doing is that money doing nothing for you. So you've worked hard, so let's get your money working for you now by gaining some interest in the likes of an investment bond or something along the lines of that. And I think they're kind of the 4 key areas that people tend to look at when it comes to investing as to why you should do it.
Okay. So if we move on to the next slide, I suppose, what process do people typically run through? And everybody on the call will see the QR code that they can scan either on the call, or we'll send them the code after the call.
Yeah, so like you said there, the QR code on the right-hand side there is basically to chat with myself or any of my colleagues over the next few days, have that 5-minute chat around potentially look at investment options for yourself. But I suppose how the process basically works is, first of all, we'll go through a fact-finding stage with yourself. So before we look at any investments, we want to understand what your current financial situation looks like. We want to see what you have in savings, what your pension looks like, what your income looks like. Do you have any mortgages, debt, and so forth? You need to get an overall understanding of your situation, first of all. Then once we've seen that, then we'll look at your objectives. What do you want to achieve with your savings? So we always break it down short term, medium term, and long term. So you always say short term is less than 5 years, and that's something that you want to keep on deposit, easy access for an emergency, in case the heating needs to be repaired, you need a new car, and so forth. I think James would agree with me there on that side. Yeah. So then after that, the medium to long term is 5 years plus, and that's where the likes of ourselves can really help you out. And James will go through that in a couple of minutes. But I suppose on that as well, it's all about, your risk profile. So everyone has a different attitude and appetite for risk. And I suppose it's really important that we go through that with you on an individual basis, because, my risk appetite could be completely different to yours, Claire, as it probably is to James's as well. So it's to make sure that we understand each person individually.
Okay, great.
Then obviously, next comes the recommendations, So like what I always say is, if you have, say, for example, €100,000 to invest, the recommendation will never be invest the whole €100,000. It'll be keep a portion on deposit, as an emergency fund, easy access. Typically, we say about 6 months net pay. And then the remainder, we break it down into the medium and the long term. And that's how we'll structure it in a way for yourselves. So we make a recommendation for you from that side of things too.
Very good.
Then if you're happy with the recommendation, simply we'll go through the application process with yourself. We'll go through the relevant paperwork and so forth with you, what kind of documentation we'll need from you, such as ID and proof of address, and get it set up for you.
Right, great.
And then I suppose the last part, and arguably the most important part, is that, you know, you set up an investment bond with Irish Pensions and Finance. It's not a simple set up and see you later job. It's really important that you review your plan with ourselves. Whether you're investing €5,000 or €500,000, it's really important because it's going to form a big part of your financial plan. So reviewing the plan with us annually or every 2 years, I think is crucial. So that's a big part
Right.
of the consultation process with ourselves. Yeah.
And I think that was great to see so many existing customers wanting to come on the call this evening. And just to say, like, it's great to have James here because James, typically you work with the broker market. So it's great for you to come on and bring your expertise, and our customers have access, exclusive access to that.
Yeah, Claire, I mean, we often talk to an awful lot of advisors around the country, but it's the advisors are talking to clients and, you know, ordinary people up and down the country, and the same questions, you know, keep coming up, you know, what should I do? How should I think about things? You know, and how should we, you know, structure things? And certainly, you know, what we find is, you know, by talking to advisors and to, you know, advisors like IPF, often once you have a plan, at least then you've got, you know, you've got a direction that you're going in and you can stick to that plan. And as Jack was saying, I think that's one of the most important things. You might need to change that plan, of course, that things change, but that's fine too. That's where your advisor, the likes of a Jack, will step in and say, well, look, you know, your circumstances have changed for whatever reason, and this is what we think we should change your financial aspirations to be and where your investments might be. And that gives an awful lot of people, you know, it's to sleep easy at night. They know that all their questions, you know, have been answered. They know that they're not missing something, and they feel content, you know, that, okay, that's the plan. We're very happy with it. We stick with it. And I think that's just crucial. It's actually just having the plan.
Great. Okay, so will we get into it then, James?
Well, Claire, it's a very busy time, isn't it? I mean, every
I
time I look at my phone, Mr. Trump says something very different, and the markets react incredibly different. You know, there's
actually, I was saying to James before we jumped on this call that, you know, a lot of customers have questions about Trump. He featured very prominently in the questions tonight.
Yeah, he's certainly driving markets at the moment. There's absolutely no doubt about it. You know, I think, you know, when we've been talking to a lot of our clients at the beginning of this year, you know, we said there was a number of factors that were likely to influence investment markets, and, you know, Trump and what he was going to try and implement is certainly one of them. And I'm going to come back to that in the next slide, Claire, because there's so much actually happening with Trump. Well, there's so much happening even on an hour by hour basis, but I think it's very, very important just to try and distill it into certain segments so that we can react or not react as need be to those segments. I think the second thing, you know, that as investors we have to be very aware of in 2025 is that there's the interest rate debate. And this is all really to do with where might interest rates go, particularly interest rates in North America or the US in particular, and the Eurozone. Obviously, that impacts us more. And for a long number of years, interest rates both in America and in Europe have moved in the same direction. You know, if the US went up, Europe went up. If the US went down, Europe went down. But I think in 2025, what we're going to have is a situation that things could get quite different in 2025 in terms of where interest rates will go. And that's obviously got an impact, Claire, on things like, you know, if interest rates change by the ECB, then deposit rates that the banks are offering will also have to adjust as well.
Great. And I think you're going to go into more detail on that in a few slides' time, James.
Absolutely. Yeah.
Great.
And then the final thing really is what's happening in equity markets, and particularly over the last 18 months or so. And what we've seen there is this artificial intelligence has been the key thematic And within artificial intelligence, there's been effectively 7 companies, which are commonly known as the Magnificent Seven, which have been
Okay,
driving
the Mag 7, is that what they're
the
called?
Mag 7, exactly.
Okay.
These Magnificent 7 companies that have been driving an awful lot of the returns. And there's questions about the Magnificent Seven in terms of, what can we expect from them longer term? And that's certainly something that we'll talk about a little later on as well.
Brilliant.
So what I might do first is just move on to Trump, and I'm quite happy at the end to take more questions about Trump. But I suppose the way I would box Trump off and Trump 2.0, because obviously we had Trump 1.0, but 2.0 the second time around is going to be very, very different. I think we have already seen that in the first couple of weeks of his presidency. There's a lot more energy. There's a lot more actions being taken. And, his comments are having a greater impact on markets. And I suppose if I was to break it down really in terms of what investors are thinking about when they think about Trump, and we try and put everything else to one side, but if we just think about what he's thinking about in terms of investors and the economy, I would divide it into effectively 2. So the first 2 things that he said were, what he wants to do is cut taxes and have less deregulation. So he wants less deregulation in the financial services industry, in the whole environmental, social area, in the whole area of energy. So more drilling for oil, etc. So he wants more deregulation. So in theory, bullet points 1 and 2 should be positive for equity markets. Less taxes, less deregulation, they should be good for equity markets. Then he's also very focused on immigration. And I think that's something that's really come to the fore. And perhaps it's more, we see it more because there's more videos being posted about, people being deported, etc. But that's having a massive implication in terms of a lot of service industries. So you look at restaurants, etc. They can't get workers because they're worried in case if they're there illegally that they'll get lifted and get deported. You look at the farming, massive problems in some of the areas of the farming area where people are really concerned that, the workers on the farms, a lot of them may have come from South America and Mexico in particular, don't have documentation. And the farmers are struggling to actually get workers, and they can't get American workers to work for them. And if you can't get workers to work for them, you're going to have to increase wages. And obviously increasing wages leads to inflation. So that's not a good thing either.
Yeah.
And then finally, tariffs. And I suppose everybody in this call is fed up listening to tariffs because 1 minute they're on, the next minute they're off. And we just don't know what Trump is actually thinking. And I don't think anybody does. I'm not even sure he himself knows what he's thinking. But it's certainly having a massive implication in terms of what the impact on markets. So, I mean, if you look at this slide, first 2 points in theory should be positive. The last 2 are negative for markets. But what's really been to the fore, particularly over the last 6 weeks or so, are the last 2. And that's the bit that's actually been dragging markets down, particularly over the last 3 or 4 weeks or so.
Okay, that's great. Yeah, so this table here, what are we looking at, James?
You're looking at an awful lot of things here, Claire, and I'm not going to go through this whole slide. You will be glad to hear. What I'm trying to show, though, is that when we look at markets, we try and take permutations. We're doing a what-if scenario situation. What if this happens? How should we be positioned? What if that happens? What might we be thinking of? So what in this slide here, there's an awful lot of things moving, but what's been happening in the last 4 or 5 weeks is these have been changing very, very quickly. And what we're saying to a lot of investors at the moment, as conditions change, let us as the investment manager change the mix of investments that you have. And that's what our job is. And if you look at the next slide, I've got a picture here of a very fine looking gentleman, looking very relaxed, sitting reading some book after his dinner. And this is the famous UK economist John Maynard Keynes, and he said to investors, he said, when the facts change, I change my mind. What do you do, sir? And I think that's something that's very important at the moment, because at the moment, a lot of the situations are changing so quickly. And I think we as investment managers, on behalf of clients, we are going to have to change as well. And the landscape is changing. There's no doubt about it that that President Trump and his Vice President Vance are changing the whole chessboard of the world in terms of the politics, the way they see countries being funded, the way they see defense. And as all of that changes, particularly over the next decade or so, there's going to be massive changes in terms of where the opportunities are for investment. And I think that's going to be very important. So it's very important, to acknowledge these changes. But what you would be hopeful is that your investment manager that's looking after your money will take advantage of the changes that are likely to happen over the next 3, 5, 7, 10 years or so. And I think the key thing is to stay active.
Yes, that's what an active fund manager is doing.
That's exactly it, Claire. We sit down as an investment team at least once a month, if not more. We have a formal meeting once a month. But what we're trying to do is to work out what might happen over the next 12, 18, 24 months. And let's put our hands up. We're not always going to get these calls right. That is impossible to do. But what we're trying to do, and we think of our funds and how we manage them as our own money. Where might the opportunities be? Where might the risks be? What should we do to try and take best advantage of the situation? And that's what our job is on a daily basis. We're challenging ourselves. Where can we find opportunities to get a decent return for investors? And the situation is going to change, and we've got to change our allocations within our fund.
Okay, great.
And we hope by us changing that the clients don't have to worry too much. That's one of the things that we say, look, we'll try and make the changes within the fund. We'll try and take advantage of what's happening. And, at the moment, when you pick up the newspapers, what you see is a lot of, potentially negative headlines, what's happening with Trump and tariffs and, consumers being concerned, what's going to happen to inward investment here in Ireland? Could there be job losses? There's a lot of negativity. I think it's very, very important, though, with all this negativity that, when you listen to the radio, is to focus in on things and just remember newspapers and radios need negative news in order to get viewership or readers. And that's really what they're looking for. The bigger the headline, the better. So, for instance, in the last couple of weeks, equity markets have been selling off there. And we've had a situation whereby, it's in the headlines and everybody's listening to the headlines. But, newspapers didn't tell a lot of readers last year that global equity markets went up over 25%. That's good news. They don't like telling you the good news. They're very good at telling you the bad news. But I suppose, from a Goodbody Asset Management perspective, we've been around now for 9 years. We've launched our funds and they've been around. And, we've seen a lot of different scenarios. We've been situation initially when we launched the funds back in 2016, we had to go through the Brexit vote. I think perhaps one of the most challenging times, though, may have been around the COVID-19. It's exactly 5 years ago.
5 years anniversary, for Ireland, this week, isn't it?
That's correct, yeah. And if you can remember back then, which I'm sure a lot of us can, the whole situation of rushing out to get bread and toilet rolls and not knowing what was going to happen and rushing into offices to pick up as much stuff as you could to bring it home. And there was no vaccine at that stage. And we had a situation, where, we had equity markets which were falling and investors were there not knowing when would the world return to so-called normality. But you know what? Very quickly, after we got the vaccines, the markets reopened, the economies reopened, and we got going again. But we've also had other things, the likes of inflation came back, we've had wars, we've had lots of different things happening. And what we say to a lot of investors is that, we look at the headlines of Trump today, and we look at things like Ukraine, and in a number of years' time, from a financial perspective, there'll be, incidents that were on a long-term chart. But, generally what happens is markets get over these things. And I think the most important things when you see headlines is to stay calm, go back to, what Jack was saying about having your financial plan and sticking to the plan and not too many knee-jerk reactions. And that's one of the things that we would say to advisors.
Because I think we were talking beforehand, James, I remember in 2008, Lehman Brothers going into business and all that. And I remember customers wanting to move into cash. And those that moved into cash, they never recovered.
No, I mean, it was remarkable, but it actually happened in March as well in 2008. It was actually that time whenever a lot of the life companies in Ireland, they had instructions from clients to move out of their funds into cash. And the most movement actually happened the week before the market hit the bottom. So investors moved out of the market right at the wrong time. The market turned, and the interesting thing, on the 9th of March back in 2009, when the market actually turned, there was no news, there was no headlines, there was nothing to say,
Yeah.
hey, the market should turn. Markets can turn very, very quickly, and at the moment they're going down because of what Trump is saying. But Trump could come out with a couple of things in the next few weeks, and the market could bounce back up again. And if you miss some of the best days in the market, it can have a very adverse impact on your long-term return.
Yeah. And I mean, those people who move into cash, you're just locking in a loss.
Correct. Generally, if you've got a good exposure, to different types of assets like equities and bonds, maybe some big pieces of property within a fund, some cash within a fund as well, they're fairly diversified. They're the sorts of funds that generally do quite well over time. But time is the key part, is managing, as Jack was saying earlier on, you put some of your money into cash, very important to have that rainy day fund. You've then got some medium-term investments and then some long-term investments. And the long-term investments are the ones you should nearly almost forget about. They're the ones you should put away, maybe have a look at them once a year, talk to your financial advisor about them every so often. But don't be too worried about whether they go up or down, because if you're invested in any sort of allocation to global equity markets, there's going to go up and going to go down. That's the way they operate.
Yeah. Great. Okay.
So look, I mean, in terms of our market summary, and I will actually say that this will change as time goes on, because nobody has a crystal ball that's going to be 100% accurate. I think one of the most important things on this is that, there's no doubt about it that we're going to have a situation that a lot of equity markets this year is going to be driven by political events and what's happening. And I'm referring specifically to the likes of tariffs. But I think the third bullet point there is very, very important. I think investors are going to have to be flexible. And I think too, at times, we as investment managers, we're going to be very much humble. We have to accept sometimes markets, have taken a move that we didn't expect, and we have to put our hands up and say, well, look, that's not working. If it's not working, let's get out of it quickly and let's get into a position where we feel something can work for us. And I think that's going to be one of the key things. But overall, what we'd be saying to investors is, yes, it's been a challenging 4 weeks or so. That volatility is likely to persist for another little while. There's no doubt about it. But I think if we step back and we think about Trump in particular over the medium term, one of the first challenges that the Republican Party and Trump face is going to be the midterm elections. And they're going to be happening in around about 18 months from now. And if they're going to be happening then, what Trump will want to have happen is that the US economy is starting to recover very strongly, and equity markets are recovering as well. So if he's going to make changes and he's going to implement cuts, with Elon and everything else, he's going to want to make all those changes at the very beginning of his presidency, like what he's doing right now.
Okay.
So for the next number of months, don't be surprised if there's more headlines coming out about what he's going to do. But I would suggest that as we get to the second half of the year, those headlines are going to start to moderate quite significantly, and the focus will be back in on the economy, getting jobs growth really kicking off again, looking at good increases in salaries, looking at spending increasing, and looking at things like more manufacturing coming back to the US. So I think what we'll likely see towards the second half of the year is much less of the headlines than what we've seen over the last month or so.
Okay, that's a really interesting perspective about the midterm elections. Okay, great.
So I mentioned the Magnificent
Seven we were talking
Seven.
about.
Yes, exactly. These companies that have really driven a lot of what's been happening in the market. And I suppose what we've seen in the last couple of weeks is lots of questions like, for those of us that have been around long enough, and Clara and Jack, I don't think you would have seen it all, but is the dot-com bubble in the late 1990s.
Yeah, I remember.
But you probably read some of the books, Claire. You wouldn't have remembered it. But it's the same sort of situation whereby a lot of investors today are seeing these companies, the likes of Microsoft, the likes of Google, Alphabet, the likes of Facebook, all investing a lot of money in artificial intelligence. And the question that a lot of investors have is, can they get a return on that money? But these companies are very, very important now to global equity markets. And the reason why they're important is that they account for a large percentage of the global market. So if you look at the next slide and you think of these 7 stocks, back in 2019, just before COVID, these 7 stocks accounted for 10% of the global equity market. Today, they account for over 20%. So these 7 stocks are driving the performance of an awful lot of global equity markets and a lot of performance for a lot of investors. And the question a lot of investors have today is, can you get a return on it? So in the next slide, you look at what these companies have invested, over 1 trillion. Now, 1 trillion is a massive number. I can't even begin to try and picture what a trillion actually looks like, but it's a massive amount of money that's been invested in artificial intelligence. And a lot of it has been invested in the likes of data centers, because that's where a lot of this work will actually happen. And investors' questions today is, will it actually be worth it? And I think some of those questions are arriving from, when they actually talk to companies and talk to employees. So for instance, in the next slide, this was a survey which was done by Gallup in the last quarter of last year, and it was done in the US. And if you just look at the headline on the left-hand side, it was asking employees saying, are there companies taking action on AI? Are they bringing it into their businesses? And 1/3 said yes. That means 2/3 are not. So that's a lot that are not doing it. And 2/3 of employees said they never expect to use AI. And I think that's very important, because about 16 months ago, we had a meeting with our head of information technology, and we had him talking to some clients, and we were asking him about artificial intelligence, and he was very excited about it within Goodbody Asset Management. And he was telling us, how artificial intelligence would change the way we work, etc. And he was saying, look, as a company, we have to be very careful. We need to see how are we going to implement this, because the central bank will want to know, what are Goodbody thinking about? How are you looking after client data?
Yeah.
What steps are you taking? It's not just you can jump into these things. But at the time, 16 months ago, Stuart O'Shaughnessy here, our IT guy, was saying, oh, this can happen very quickly. And I envisage that, all the employees in Goodbody are going to have artificial intelligence on their laptop within a number of months. And today, I don't have it. We've got working groups that are looking at it. We've got working groups that are testing it, but the adoption of artificial intelligence is a lot slower than perhaps investors initially imagined. And that's really the critical point today when you think of these 7 large companies led by NVIDIA, is how quickly will companies adopt artificial intelligence, and what would be the benefit? And I think in the next slide, it's very well put, where to next? And we liken AI really to what's been happening. 2007, Steve Jobs stood up at Apple World and gave us this. This was going to be the future. He told us, this is what he told us, our lives are going to be controlled by this. And boy, was he right.
Yeah.
But it did take a bit of time, because it took another year before we actually had the App Store. And then it took another 2 years before we started getting apps that were of real use, that we could use, whether it was WhatsApp and phoning people and everything else. And I think, it's very well put. There's a quote from Sebastian Malby, and if you just click on to the next part, there's a backup one. And basically what he said is that where we're at today is effectively like 2007. It's the iPhone moment with artificial intelligence.
Right.
It's really just driven down the lines. We've been told it's going to be brilliant. It's going to make so much changes to our lives, greater efficiency. It's going to have cost savings, but we haven't got the platforms yet. We haven't got the applications. So we're in a little bit of darkness, but undoubtedly they will come. It's just a matter of when.
Yeah, that's interesting, because even in here, we're looking, going, how could we use it Where would it be helpful? Where do we still need the human touch? You know, all those things.
I think, Claire, undoubtedly there'll always be the human touch, because I certainly know when I'm trying to change an airline ticket or anything like that, I need to talk to somebody that can do it for me. These bots
Absolutely.
do not do it for me, I'm afraid. So you'll always need the human touch as far as I'm concerned. But
Very good.
there's a lot of efficiency can be done in the background.
Yeah.
So maybe just moving on to the investment solutions, and as we were talking a little bit about earlier on about, you know, cash, and people often have had cash, and Jack was outlining that, you know, we had inflation in the Eurozone over the last 3 years, and with the inflation, what we had was the European Central Bank increasing interest rates, and they certainly increased interest rates quite substantially. And that resulted that, you know, investors that put their money into a deposit got a reasonable return. And what I'm showing here is over the last 3 years or so, that this is the cash fund from New Ireland Assurance, and IPF work with New Ireland as one of their providers. So if you invested in the cash fund, effectively what you're investing in is a lot of different types of deposits. But over that period, you know, the cash fund has returned 7.4%. So not a bad return in terms of what is happening.
Mhm.
But the challenge today for a lot of cash funds is that interest rates in the Eurozone are coming down. So the rates of return are likely to be less. So what I'm showing here in this chart is the market pricing of interest rates in the Eurozone. So if you look at the very left-hand side, what you can see is that back in January, they were saying that interest rates in the Eurozone would be roughly about 3%. Now, we've had an interest rate cut last week, so they're down to 2.75. But if you look towards the end of the year in October 2025, what you see is that interest rates are going to fall even further down to below 2%. So if interest rates officially are at 2%, bank deposit rates are going to be an awful lot lower. So putting your money in a bank going forward isn't likely to give you a decent rate of return that's going to protect you from inflation. And that's one of the key things I think a lot of investors need to consider.
Yeah.
If it's not going to work for me, where else might I put my money?
I mean, this is great. Say if you have anybody on the call who has a tracker mortgage, you know, you're delighted you're getting your letters in from the bank and the mortgage is going down. But if you have savings, that's when it's an issue.
That's exactly it, Claire. That's the situation. You know, the banks will be very quick to lower the deposit rates. You know, they mightn't be as quick if you don't have a tracker mortgage. They might hold it a bit higher for longer.
Yeah.
But there's no doubt about it that I think the world that we're coming into, and you think about Europe generally, we've got a situation whereby, you know, economic growth is very pedestrian, I would say. They're going to have to lower interest rates to try and stimulate growth. And if they're going to do lower interest rates, then the bank rates that we can get, you know, for deposits are going to be a lot lower going forward.
Perfect.
So looking at some of the investment options, I mean, you know, I think it's important just to go through the range of them. And, you know, cash is very important if you're looking at your short term, there's no doubt about it. But if you move up the risk scale a little bit, you might consider something like a government bond. So a government bond is effectively, it's almost like you're lending money to the government and they give it back to you with a guaranteed rate of return. So you've got the government on the other side. So for instance, the Irish government will issue bonds. They might issue bonds for 1 year. They could issue a bond for 5 years or 10 years. So if you buy that bond, they are guaranteeing you a certain amount of return. It could be 1.5% over that period or 2% over that period. Corporate bonds, they're just like government bonds, but these are issued by companies. So often you see companies, the likes of, a lot of car manufacturers issue corporate bonds. So BMW issue a corporate bond. So you're relying on BMW to pay you back the loan that you've given the company at the end of the period. So they're slightly more risky. You don't expect the government to go broke. Companies can go broke. So it's slightly more risky. If you go up the scale further, you've got property. Obviously, some people will have invested directly in properties. Maybe it's residential. Maybe some people are considering some commercial property. I think one of the other key things, though, is that those sorts of investments tie you up for a long period of time. So you've got a liquidity issue. You could have perhaps a risk that, you get a bad tenant. There's different risks with property that go in directly. So maybe investing in a property fund where you've got a range of properties within the fund, that might make more sense and gives you greater flexibility. Then the next one would be commodities. So, I mean, if you've got a firm view on oil and gold or any of the other commodities, could be soft commodities, you could invest in that. But once again, slightly more volatility as you go down the page. Equities are the next one. So these are stocks and shares. I suppose if you look at the Irish market, you'll be looking at the likes of some of the banks, AIB or Bank of Ireland. These are stocks and shares. They can move around a bit. Markets go up, they go down. Generally, they go up over time, but as we've seen historically, you'll always get some volatility. And then finally, crypto.
Yeah, we had some questions in on crypto. Every year we have questions about crypto.
Oh, exactly. Well, if you want a bit of a roller coaster, that's where you want to be going to. I mean, there's so much happening in that whole space. It's just so volatile and it keeps changing all the time. And the whole rationale as an asset class is heavily questioned. And certainly I'd be very careful in that whole area, Claire, personally. I just think that, there's so much going on there. It's there's question marks and not something that I'd be considering as a long-term investment.
Okay.
But I think, what you do see here is that, you've got different risks, and that's important, as Jack was saying earlier on. Every person, every client is different. They've got different risk levels. So, you've also got to accept, if you get lower risk, potentially lower returns, a bit higher risk, you get a better return. So you've got to adapt all that. And, really what, IPF do is really just look at your overall situation.
Mhm.
And, everybody's almost what I would say like a jigsaw. And if you look at the next slide, you put everybody's situation, because everybody's got a different situation, got different number of children that are dependent on them, that maybe have obligations that they have to, to look after, maybe parents in nursing homes. You've got situation, you're paying for a wedding, but everybody has a different perspective and different amounts of money, but also different attitudes to risk. Because the last thing, we want is anybody going to bed at night worrying about their investment. That is not a good situation to be in. So there's jigsaws. We got to look at what's your requirements, but we've also got to look at your levels of risk. And really what the advisor and talking to people like Jack will do is try and put together the jigsaw and say, look, this is what we think is a good outturn for you. And often what, the recommendation will look like is maybe a fund like a multi-asset fund. So it'll have different allocations to some of these different types of assets. And the two funds that we run are called the Goodbody Dividend Income 3 and the Goodbody Dividend Income 4 funds. And
so these are a mixture of these assets, James.
That's exactly it, Claire. So we have different assets within them. So on the Dividend Income 3, we have dividend paying global equities at about 42% of the overall fund. We then have more secure government bonds. We've got some corporate bonds. We've got cash. We've got a little bit of property in there. And Dividend 4 is exactly the same, only it's got a more allocation to equities. So you've got a greater potential there for a return, albeit, as I showed in the previous slide, risk and return are balanced. So you've got to think about how much risk you want to take on board. But effectively within these funds, what we can do is we can change the allocation to the different asset classes depending on what's happening in markets. So as markets change, we can change the mix on behalf of clients. And that's one of the key attractions of multi-asset funds.
Very good.
So we've been around for 9 years at this juncture, and we've worked with IPF over those 9 years very, very closely. And what I thought I'd do is just look at a number of instances, that have occurred, because we've got a lot of headlines at the moment, a lot of nervousness. And this first chart, I've just looked at COVID, and it's on 5 years ago, as you were saying, Claire, at the beginning of this month.
Mm-hmm.
And at the beginning of this month, back in 2020, markets started falling and falling quite sharply, down over 30%. So the blue line on this chart shows the world equity market falling down over 30%. If you look at this yellow line on this chart, it's the Goodbody Dividend Income fund number 4.
Number 4,
and
okay.
that fund didn't fall anyway as much. It actually fell around about 10%. So the market went down over 30, the fund went down 10. But what you see over time is that the fund has done particularly well in different market conditions that we've had over the last 5 years. But if you were to put your money in cash and put it in the cash fund, your return over that 5-year period would be about 6.7%. So putting your money in equities, which, I think it's fair to say very few people will have all their money in equities because that's a high risk strategy to be taken. Most people will have their money in a multi-asset fund, the likes of a Goodbody Dividend Income 4, or maybe one that's an ESMA 3, which is slightly lower risk. But what you can see is you can get very decent returns from these multi-asset funds over time, particularly compared to cash. And that's, I think, is something which is very important. And I'm sure talking to advisors, the likes of Jack would be saying, look, you can mix and match. You can have a little bit of this, a little bit of that. What we'll try and do is get you a decent return over time.
Yeah.
The second period I just want to look at is obviously we haven't had a war in Europe in a long, long time, but we did have one 3 years ago. So this is from the period whenever Russia actually invaded Ukraine. So we're just going back 3 years. So once again, the red line is the cash. If you put your money in cash, and you'd have got about almost an 8% return in that period. And there's no doubt about it. Markets were volatile whenever, the invasion happened. Oil markets went up significantly. People were very worried. So it took markets a little while to recover. But if you even look over the last 3 years, what you can see is that world equities are up about 25%, and the multi-asset fund is up around about 16%. So if you can stay invested, it's not a bad time to actually be doing it. And that's one of the critical things. We didn't know what was going to happen with the invasion. We still don't know how it's all going to play out, although we're probably getting a little bit closer. And I see some headlines even in the last hour or so saying that there's the potential for a ceasefire. But the situation is that, once again, if you're an investor, if you have a plan and if you can stick to it, generally it works out quite well for you.
Okay, very good.
And then finally, coming back to Mr. Trump, this is just taken from the time of the election back in early November. Markets initially rallied. You might remember they all thought, oh, great, tax rates are going to be cut, less regulation, this is going to be brilliant, the markets can all take off, etc. And you know what? They did. The world index went up nearly 10%. But what we've seen over the last couple of weeks, people have become a lot more concerned, particularly over what's happening in tariffs. And we've had quite a significant sell-off. So in this situation, cash has been a lot more constant. You got a 1% return from cash. You've got more volatility in global equity markets. Multi-asset funds have done okay, up about 2%. But what I will say is, this is very short term, and never, should anybody be thinking about investing, over a 3 or 4 month period. But I was just trying to highlight there, we've got different situations that have been happening. But if we step back and think of the long term, generally, these look like blips on a very small chart and you don't actually see them.
Okay, very good.
So if I was to leave everyone with any sort of advice this evening, I think one of the key things is everybody is very different in terms of what assets have you got, what obligations might you have, what liabilities might you have, what's your attitude to risk. So one of the most important things is that, you should talk to an advisor about your situation itself. The second thing is that you need to be establishing what is your attitude to risk. That is very, very important. We don't want anybody going to bed at night worrying about where their investments are. We want people to say, yeah, I understand what's happening. I understand that markets can go up and down, but over the long term, generally we do quite well. The other thing I'd say to a lot of clients is that try to reduce your risk by understanding what you're invested in. So if you know what sort of companies are in your fund, and we invest in some of the biggest companies globally. If you know those companies and you understand those companies, you're more likely to stay invested. And Claire, I'm coming back to your point about what happened back in 2009. At the very worst of the financial crisis, people just got very frightened and they didn't know what they were invested in. They said, just get me out of the market, put me in cash. So I think it's much more important when you can actually understand what companies are in this fund, where's the exposures? Actually, I understand that company. You know what? Share price can move around a bit, but I still like that company. That's one of the most powerful things. Then finally, have your plan and stick to it. And I think that's crucial. There's always going to be volatility. We're always going to have news headlines. But the main thing is that you have your plan, you talk to your financial advisor, and you should stick with it.
Very good. Great. So I think just before we open the questions and answers, we're going to just get a little bit more under the bonnet with Jack Stevens for the customers on the call. So James, that was absolutely brilliant. It's a really good
Thanks,
overview
James.
of
That was
where
great.
everything is now. So Jack, I suppose customers on the call, right? They're asking some questions, right? And as I said, we have the QR code there, and they can, scan it and click in for a 5-minute conversation with an advisor. Just some very kind of general questions. So if someone's looking to invest, how much typically, should they have available, or can they invest?
So the minimum investment, Claire, with IPF is €5,000 for a lump sum investment. We also offer regular savers plans as well. So people are looking to fund for children's education in the future as well. There's another option there free. But with, around availability, going back to what James said earlier on about having that emergency fund, typically we recommend 6 months net pay on deposit. And then you
Okay,
look
so
at your
6
investment
months.
options after that.
Okay. Yeah.
That's to
Great.
fix the car, to change the heating, any kind of issues you might have in the house.
Great. And then, so if someone's thinking of investment, what are we talking about from a time frame point of view?
Yeah, so that then goes back to the short term, medium term, and long term. So if you're looking to invest, we typically say medium term to long term. So 5 years onwards is what you're looking at from a time frame perspective. Less than 5 years, we don't recommend you invest, because like James said there, if you invest for 3 or 4 months, you don't know what's going to happen. One day you could be up, the next day you could be down. So we don't recommend it over a shorter period of time.
Yeah, we saw this, the kind of the few months and how volatile that is.
Yeah, exactly. Yeah. I
Okay.
think that was a really good slide there about it. Yeah.
Yeah. And then I suppose from an objective point of view, what are typically people's kind of objectives with the lump sum and investing it?
Yeah, everyone's objectives vary again, and I think that's why it's really important to sit down with your advisor and chat to them for 5 minutes over the next couple of days. But from my experience of dealing with clients over the last number of years, if you have a lump sum, say for retirement, that people want to use as money to live off at retirement, and that's to gain a bit of growth on it as well. So when you're dipping into your €100,000, it's not decreasing to €90,000 straight away, that you're getting your money working for you in the background. Again, other objectives can be around education for children and so forth as well. So just understand what you want to achieve with your savings and how do you need to achieve it. We can help you along with the way with that, basically.
And then say, for instance, if somebody says, okay, I have a pot of money I want to invest, but is there an option to take any income from it?
Yeah. So you can add on an income to your investment bond in the future, or you can set it up from the get-go. I have a few clients I've done it with recently enough, and I think it works very well, particularly for people post-retirement, but also for kind of education funds and so forth as well, that you can have your lump sum invested still while taking a certain percentage out every year, say, for example, 5%. So it can just work very well that you can get an income paying for you while the remaining capital is still invested for yourself in the background. So it's kind of washing its face in its own way, So it works very well from that side of things too.
Very good. And then I suppose access, is that the same question as the time frame, or what does that mean, Jack?
Yeah, I suppose it is. Like at the end of the day, you can still access your investment bond if you need to. But going back to that, the idea that we look at investment plans is we always recommend you have your emergency fund, you have your 6 months net pay and deposit, and the rest you don't need for that 5-year period. Of course, you can access it if you need to. And I've had clients in the past go, geez, I actually do need to access this. Can we get to it? Yes, you can is the answer for that.
Okay. And we go to the last slide then, just I suppose some things that we like IPF will go through with customers. And once again, this is under the bonnet, so we're just going to tip on it now, but we'll discuss it in more in depth when we're speaking to them. So when we think of investments, Jack, what does allocation and fund management mean?
So allocation is essentially the amount of money that is going to be invested in the investment bond for yourself. Typically, it's 100% allocation, and your advisor will go through that with you on an individual basis. And that's the same with the fund management charge as well. The fund management is basically a percentage of your investment that you basically pay for. And that's basically what the fund management is. I suppose economies of scale, though, the bigger the investment, the smaller the management fee.
Great. Okay. And then is there typically are there extra charges for a more specialized fund?
Yeah. Certain funds will have a more specialized funds will have an extra fee. And I suppose with that, it's because they tend to be actively managed and they work quite well. And then they offer sometimes the likes of downside protection. And that can really give a lot of clients peace of mind, I suppose, when markets are a bit shaky at times, So I think the extra fee for those specialized funds, they're warranted. I think they're well worth it. And I wouldn't disagree with any of them, to be honest. I think they're well worth it,
Very
yeah.
good. Okay, so say if I take out an investment now and then in 3 years' time I have an extra amount of money, can I put more money into it?
Yeah, of course. Yeah, you can always top it up, and you can top up your investment at any stage. But I suppose on the topping up of an investment, I'd always recommend think of the time frame again. So you've done an investment 3 years ago, and you're topping it up. Don't think that money's only invested for 2 years. You want to be thinking 5 years again for that, because you're still looking at the time frame for the new investment.
Okay,
Which,
that's
you
good
can top it up.
advice. Look, I think we discussed encashments.
Yeah.
What about debt?
Yeah, so what happens on debt essentially, what I always recommend for all my clients, if you're married or if you're a couple, is that you put the investment bond in two names. So yourself and your partner's name, because if you pass away, your partner then has the decision as to whether they disinvest the funds straight away or keep the funds remaining and invested for yourself. Whereas if it's in your own name and you pass away, it's disinvested straight away. So your partner will still receive it, of course, and there's no issue around that for next of kin and so forth. But investing it in two names is really important there.
Gives you more
And a
options.
good way to look at, yeah, more options essentially, yeah.
Great. And then our friend, the taxation, Mr. Taxman wants his piece of the pie.
Yeah, unfortunately, there will always be a bit of tax that you'll pay on the growth within an investment bond. Your planner will go through that with you individually. But again, the returns you get in an investment bond are better than you will get in the bank. And I suppose you will pay a bit of tax on the growth.
Okay. And then I suppose review of the plan, which probably brings us to our last slide again, is, why is it so important to review your plan?
Yeah, I suppose it is very important to review the plan because things change over time. Like James said, try stick to your plan, but sometimes you mightn't always be able to do that. And that's where sometimes sitting down with an advisor and reviewing your plan can warrant certain things to happen. So I suppose, the likes of a fund switch may occur. Wouldn't recommend a cash switch and everything like that. But if you do want to change funds, we can do that for you at certain stages, Also as well, your risk profile may change as well. And that's what we need to address as well sometimes. And also as well, unfortunately, sometimes the goals change too. But it's all about, sitting down, reviewing your plan regularly. And I suppose just one example, Claire, I actually have there is I did an investment with a client 4 years ago, and we actually went into the Goodbody Dividend Income 4 fund. And I sat down with him last month, and 4 years later, he was telling me what his plans are for next year. So this client has an idea what he's going to do in his shed in his back garden with his investment bond in
Very
a year's
nice.
time. So, for him, he stuck to his goal, and he's going to be there next year. Like that, look, it can change for people. So just to make
Very
sure that
good.
you do review it regularly with myself or anyone at IPF.
Now, before we get on to our competition, our quiz, Sarah,
Yeah.
we said
We might,
things.
yeah, we'll be open up for a couple more questions. And just while people are sending them in there, James, I was just having a quick look back through some of the questions we got in beforehand. One thing I saw come up a few times is around S&P 500. You might just give us an idea what that means. I suppose people are asking how could they go about investing?
Yeah, so the S&P 500 is probably the most diversified market in North America, in the US in particular. So there's a number of different markets in North America and the US. So you've got the Dow Jones, which is probably the most common one, but the Dow Jones only has 30 companies in that index. The NASDAQ, another very common one. Typically, the NASDAQ would be incorporate companies that are technology companies. So think of your Microsoft, think of your Meta, Facebook, or your Google, Alphabet. They're all in the NASDAQ index. But the S&P 500, it's the top 500 companies that are quoted in the US market. So it's a broad range of companies. So you have some technology, but you've got financials, you've got materials companies, you've got utilities, you have a very wide, diversified range of companies in the S&P 500. And effectively, it's just an index based on the size of a company. So if you think of a large company, the likes of Apple, Apple, is the largest company in the market. It accounts for, 4.5%, 5% of the overall index. So that's going to be a large driver of the index. But you've got much smaller companies in there too. So it's the index that a lot of investment managers would look to. If you ask a fund manager, if you're thinking about the US market, the S&P 500 is the company that you'd invest in. And I suppose for a retail investor, if you're looking to invest in that, I mean, there's different ways to do it, but there is index funds that just follow the performance of the S&P 500. So you could potentially look for one of those. And, if the index goes up 1 year, you'll get that return less any charges. If the index goes down, you'll also incur the losses less any charges.
Great, okay. Brilliant. And Jack, I might bring you in on this one. One gentleman was asking, what's the benefit of using a professional advisor over picking their own stocks or shares?
Yeah, I think the big benefit, comes into, reviewing the plan regularly, having someone who has a bit of knowledge regarding investing and financial planning. And I suppose stock picking is very, very difficult. And it's something that I wouldn't even do myself. And I suppose that's where the likes of your multi-asset funds, like James had mentioned earlier on, comes into factor. That going with ourselves, that we can really help you tailor the plan specifically for what you want to achieve, rather than just trying to pick a company that you think might do well in a year's time, So it's very much a gamble if you're going in by yourself, just picking a company on your own accord, So I wouldn't really recommend them.
Yeah,
That's where we can help
absolutely.
people by.
Let the fund manager and the advisor do their job.
Yeah, exactly.
Great. And we had a couple of people on as well that are obviously very generous parents, because they're all asking about investing for their children's futures. So is there any kind of funds in particular that if somebody's looking to maybe put in a regular amount each month, they're thinking about their children's education in the future, is there any particular funds geared towards that, or would it really depend on the individual situation?
Is it my parents, Sarah, that are asking that question? No, but yeah, again, it comes down to the risk profile, of the parents, I suppose, because the children are too young to understand risk properly and so forth. But again, just picking a fund suited to their profile, depending on the time frame, So like James said there, if it's very long term, so the child is a newborn and you've got 18, 20 years, maybe something about higher risk can work a lot better, Whereas if you only have 5 or 10 years, something like a medium risk multi-asset fund can work very well as well. So it's again about establishing the goals and objectives and looking at the time frame again on it.
Brilliant. Okay.
So I'd say,
Thank you for that.
Sarah, we might, because I know we have a lot of questions, so we will
Yes,
be in touch with
absolutely. We
everybody
might-
afterwards.
Yeah, absolutely. And anyone with any specific questions in particular, click the button tomorrow and we'll absolutely get an advisor in touch with you and they can go through all your own personal details with you. But in the meantime, I'm going to open up the question. So again, as we said at the start, this is something that has been brought up during the actual presentation. So I'm just going to move on to the question now. So in what year was the Apple iPhone released? So I believe James gave us that nugget of information.
From somebody.
It's a few coming in quick there. Okay, brilliant. A lot of eager beavers.
Saw an IPF, someone from IPF putting their answer in there. Sorry, Dylan, you won't win.
Oh no, I don't know about that now. I don't know. But I think the first one I'm seeing with a correct answer is Kate Doherty.
Yeah.
So well done, Kate. And so the answer was 2007. Doesn't seem like that long ago, does it? But there you go. So well done, Kate. We'll get that voucher out to you in the post. So congratulations.
So look, thanks very much, everybody. Thanks, James, especially for all the content and for working with us this evening. Thanks, Jack, for giving your insights from the advisor's point of view. Sarah, as always, for putting everything together. And we will be in touch with everybody. If they want to speak to the advisor, just click the QR code and they can request a 5-minute appointment. And the meetings are complimentary and the conversation is complimentary.
Yeah, perfect. Thanks very much, Claire. That's great.
Thanks. Have a nice evening. Bye.
Thanks, James and Jack.
Thanks, Carl.
Thanks.
See you
Bye-bye.
later.
Bye-bye.